Hi, this is Andy Hoffman, Media Director for Miles Franklin Precious Metals, celebrating our 25th year in business. It's Friday, May 2nd at midday, and today's audio blog is titled Unprecedented Desperation. Now, how fitting that on the third anniversary of the May 2011 Sunday night paper silver massacre, and barely a year after the April 2013 alternative currencies destruction raids, we witnessed one of the most blatant, desperate weeks of paper precious metal tax I can remember. I gave a chronological description of how the cartel's manipulation strategy has evolved over the past decade yesterday, with the key point being that since dollar price gold peaked in September 2011, that is the cartel, the Western bankers, realized precious metals must be suppressed far more so than in the past. Worldwide demand is simply growing too rapidly, given the fundamentals, and even concentrated blitzkrieg attacks like the Sunday night paper silver massacre were having increasingly short half-lives. The September 2011 Operation PM Annihilation 1, which occurred right as the Swiss bank was devaluing the franc, had a half-life of about 3 months. The December 2011 Operation PM Annihilation 2, which was enacted as the ECB was lowering interest rates, when they even put out a fake headline saying that the BIS, the BOE, and the Fed were selling gold, had only a 2-month half-life. And then, of course, you had the 2012 leap day violation in February, which worked for a little longer. But again, by the spring of 2013, prices were surging anew. And thus, on April 12, 2013, the alternative currencies destruction attack was launched. That morning, Obama had a closed-door meeting with the CEOs of the 15 largest too-big-to-fail banks. And coincidentally, Goldman Sachs put out an aggressive gold short sale recommendation. Then, with absolutely no news provocation, gold and silver plunged by $250 an ounce and $6 an ounce respectively in just 2 days. And since then, the paper attacks have been relentless. On 90% of all trading days since, gold has been attacked at the 2:15 a.m. open of the London pre-market paper session, and Sunday night sentiment raids, as I call them, have been undertaken for the past 39 Sunday nights. Essentially all key attack times from the 8:20 COMEX open, or should I say the 7 o'clock pre-market open in the United States, to the 8:20 COMEX open, to the 10 o'clock Eastern Time close of the global physical markets, the 12 o'clock p.m. Eastern Time cap of last resort, as I call it, and the 2 o'clock p.m. Eastern Standard Time crybaby attack time have been utilized nearly every day since. Not to mention, prices are now walked down just after the New York Stock Exchange close and just after the 6 p.m. Eastern Time open of the ultra-thin Globex paper trading platform nearly every day. And paper gold prices, of course, are walked down at the close of the New York Stock trading almost every day as well, just as the Dow Jones propaganda average is walked up via Hail Mary rallies. This, my friends, is the unprecedented desperation that inspired today's blog title. All PM bullish news recently has caused the cartel to cap prices, and all, quote, bearish news, as if there was any, to attack. And if that doesn't work, they just attack at all times in between. This is the true state of precious metals, as I wrote yesterday, following up on the Convergence of Doom and World of Economic Rot articles the 2 days prior, discussing the true state of the precious metals supply and demand in the global economy. While all this was occurring, physical demand continues to surge, with the U.S. Mint on pace to exceed last year's record Silver Eagle demand by a whopping 30%, despite weekly rationing of roughly 1.2 million ounces. Chinese gold demand is on pace to shatter last year's record level, and when the ill-fated Indian tariffs are inevitably lifted in the coming months, it will only cause demand to spike further. Meanwhile, the mining industry continues to edge toward the precipice of total annihilation, and again, I cannot emphasize enough my belief that it will never recover. The fact that the huge egos of the CEOs of Newmont and Barrick prevented a merger that might have saved a few dollars in a money-hemorrhaging business only proves my point further. That is, that prices are way below industry-wide production costs, and thus will only result in further catastrophic losses, as well as draconian reductions in production, capex, and development expenditures for as long as prices stay down here. Now let's move on to the week's headline news, which according to the mainstream media is why you need to buy stocks and treasuries and sell precious metals. Okay, so Tuesday, Case-Shiller, the real estate index, came out with its longest home price decline stretch since 2012. 13 of 20 cities experiencing price declines. And this follows up last week's ridiculous 15% drop in existing home sales. For those who still believe there's anything left in this Fed-created, Wall Street fostered housing dead cat bounce. Wednesday, to make the point further, Mortgage Banking Association, mortgage originations down 6% 2 weeks ago and then 3% last week to a new 20-year low. Their refinancing index down 7% last week alone, and again, interest rates haven't been going up to their lowest level since the bottom of the 2008 crisis. Yes, a lot of money funneling into the economy. How about GDP, which gold was not allowed to go up on? Up a measly 0.1% versus the expectation of 1.1%. Actually, it was 0.05%. And they were using an historically low 1.3% price deflator despite the surging inflation that we've seen, as validated by the next day's report showing a 5% surge in March farm prices and then a 4% increase in April. Overall, food price indices are up a whopping 20% in the first quarter alone. And as I mentioned last week, Safeway, America's second largest supermarket chain, just said they will now be passing such costs along to customers. And by the way, John Williams of Shadowstats analysis shows that the GDP collapse had nothing to do with the weather, which, as I demonstrated in my piece, Mother Nature has had enough, wasn't even statistically abnormal for the nation as a whole. And then we have Japan, which announced, as their stock market has stopped going up, by the way, it's now been a year since it's gone anywhere, 22 straight monthly wage declines. And its manufacturing PMI plunged from 53.9 to 49.4 in April, celebrating the one-year anniversary of Abenomics and the increase in the sales tax, in the national sales tax from 5% to 8%, which will soon be 10%. This was its first contractionary manufacturing PMI print since February 2013, which was just about when Abenomics started, and the biggest monthly drop on record. But the real damning news was that Sony, one of its largest, most profitable companies, cut its earnings forecast by 70% and blamed Abenomics for a large part of its problems, saying a weak yen does not help them. So in other words, what does it help? Since we have record inflation and a collapsing economy and record debt. As I've written before, the news continues to tighten, and it is inevitable that we will see some kind of hyperinflationary and or massive debt default event in the land of the setting sun. Then you had Europe, Draghi in a speech. He's ready to use QE, or as they call it, the OMT, or outright monetary transaction. And the Eurozone put out their BS CPI report of just a 0.7% year-over-year increase in inflation, as they again continue to bring out the propaganda they need to further destroy Europeans' way of life with more money printing for the benefit of the 1%. European sovereign debt lows soared to a new record level in 2013, and for the entire continent will shortly pass 100% of GDP. And again, like our numbers here, our 17 trillion of debt, it's severely underreported by fraudulent accounting. And then you have nations like Greece at 175% of GDP. Yet thanks to Draghi's promise to do whatever it takes, like the aforementioned QE, yields have plunged to multi-year lows on sovereign debt. This is not a situation that is going to end well, I assure you. And how about Twitter, just to throw it in? The stock collapsed to new lows after this societal blight revealed almost no meaningful subscriber growth. Like Facebook, most retail investors have lost their shirts. But don't worry, the Wall Street banks made hundreds of millions of fees taking this crap public. Pardon my French. Twitter lost $511 billion last quarter, more than twice the worthless analysts' expectations. But don't worry, excluding one-time charges, just like every company on the planet, it's profitable. As I have been increasingly writing about for weeks, signs that a 1999-like bubble is back are everywhere. Stocks, bonds, real estate, the latter of which is already deflating, and tech stocks are on the verge of doing so, with only the PPT saving them at the moment. This is why QE must continue to expand, no matter what the Fed says it's doing. And by the way, what it says it's doing is it continues to print and monetize and keep zero interest rates for years to come. Now we're up to Thursday. Jobless claims surged for the second straight week. 330 last week and 344 this week, 1,000, versus an estimated 320,000. Simultaneously, the Challenger report indicated 40,000 mass layoffs in April versus 34,000 in March. And the PMI manufacturing index reported the slowest pace of job creation since January. Better yet, the Bloomberg Consumer Comfort Index, which has been negative for 13 years in a row, plunged from minus 25 to minus 38, while construction spending for April was up 0.2% versus the 0.6% estimate, and the March figure was revised from a slight increase to a decrease. And oh yeah, another monthly record for General Motors channel stuffing, exceeding the prior record set last month. Yes, the economy is growing. Then you have China, worse than expected PMI reading, following the day before provincial GDP readings that were suggesting much sharper contraction than the official 7.4% growth rate, which itself is much lower than the 7.7% which they predicted only 2 months ago. Consequently, the yuan fell to a new multi-year low, well into the range where those derivatives are kicking in and creating massive losses, per what I wrote in Chinese Financial Torture a few months back. I mean, we're talking about massive global trade and inflation implications from the decline in the yuan, and we will see them, I assure you, around the world in the coming months. And that brings me to this morning's NFP report. Oh my God, is this this might be one of the biggest inflection points in U.S. economic history. This report is so ridiculous. And the world knows it, which is why the markets are acting as they are. Last month, I predicted for last month's NFP report a, quote, worse than expected number because the benchmark 10-year Treasury yield had risen to 2.8% right before it. In other words, dangerously close to the Fed's line in the sand at 3.0%. Per my January article, 3.0%, enough said. And of course, it was worse than expected. Yesterday, I predicted a better than expected, again with quotes around it, because the BLS can make any number it wants. Because the Fed not only had a 236,000 job birth-death comparison to use from last year, meaning they would probably use a big birth-death number this year, but the 10-year rate was just over 2.6% at the time, giving them plenty of cushion just in case the market decided to sell off treasuries on a big number. And lo and behold, 288,000 quote jobs versus the estimated 215,000. Better yet, a 6.3% unemployment rate versus 6.7% last month. And again, we've discussed this at length. Remember, the Fed had a 6.5% ZIRP, zero interest rate policy threshold. They said last year, well, if the rate gets below 6.5%, we'll end zero interest rate policy. Well, sure enough, last month, or in December, when they started their tapering, which, as I've said before, they are not tapering, just read proof of the tapering mirage, they got rid of that policy because they realized it just makes them look stupid. Because the only reason that the unemployment rate is falling is because the way the BLS calculates the unemployment rate to make it look lower than it is, when people lose their unemployment benefits, they're no longer workers. So yes, 288,000 jobs were created this month, but 234,000 of them were via the birth-death model, and more importantly, 806,000 people left the workforce, causing the labor participation rate to fall near its all-time low, or I should say its 35-year low of 62.8%. And thus it exposes the NFP report for the sham that it is. Again, remember that 1.3 million people lost their long-term unemployment benefits at the end of December, and another 3.5 million were scheduled to do so this year. The year is a third over. So clearly, given the number of jobs that have said to be created, we should be in the ballpark of 1.5 to 2 million people leaving the labor force, of which half of them left this month. And I truly believe that they waited. The BLS was told to wait until the Fed officially got rid of that stupid policy before they released those people, and they didn't want to make the Fed look stupid having a below 6.5% rate and not getting rid of ZIRP. And of course, last month, Janet Yellen said it will be at least 6 months after the end of tapering, whenever that may be, when they'll have the zero interest rate policy, because clearly they know that the economy desperately needs it. There is no economy without the QE. Let alone in this great report, they said there were 288,000 jobs in their what they call the establishment survey, but the household survey, which comes out simultaneously, showed a 73,000 job decline during April, not an increase. And of course, the government itself reported all the jobs were in the low-paying, minimum wage, no benefit, retail, fast food, and temp sectors. And again, is a temp job really a job? I mean, it's half a job, or maybe a third of a job. And as for retail and fast food, yeah, we see all this stuff about waiters and bartenders, and I don't say we joke about it, but it's kind of silly that anyone is even purporting that the economy is growing because people are getting jobs at McDonald's, particularly because most of those jobs are people who are over 55 years old who just need the money to survive retirement. But the fact is that we have been reading day in and day out about the worst retail spending environment of since the bottom of the collapse. Record closures of retail stores, negative same-store comps at McDonald's. So how is it that that all these jobs are being created in retail and fast food? And even if they are, they're not going to have any impact on the economy anyway. They're not productive jobs. But I don't even believe those jobs are real. And again, it comes back to the birth-death model, which again was conceptualized to say that when people lose their jobs, a large percentage, not some percentage, a large percentage of them create their own businesses, which is actually ridiculous. In today's economy, I remember back in the movie Midnight Run, where Charles Grodin told Robert De Niro, it's a really bad idea to start a restaurant. Most of them fail. Well, that was back then. Today, starting a restaurant, let alone any business, is almost impossible to be profitable because it's so expensive. There's so much regulations out there. And of course, the economy stinks. And we know the banks aren't lending. That's what the whole point is of QE. They give money to the banks, and the banks hold on to it instead of lend it. They just invest it in treasuries and the stock market. So even that is ridiculous. And I did the math in my piece today and showed that since they created the birth-death model in 1999, 9.5 million jobs have been created. 9.5 million, that's 50,000 jobs per month. The phantom jobs that come out, where there's not absolutely zero statistical evidence that those jobs even exist, only in their algorithmic models. And of course, the reason they created it at the turn of the century is no coincidence. That's when the U.S. economy peaked, and it's also when the jobs started to really leave and go to China and other places east. So the government said, look, if we don't replace those jobs with some phantom jobs, it's going to look like people will see just how bad the labor situation is. And of course, it's gotten much worse, especially now that the system collapsed in 2008 and there's been a wholesale, there are no jobs. Forget the jobs going to China. There are no jobs to start with. By the way, I put a chart in today also. I saw it in Zero Hedge. We lost about 8 million jobs in 2008 to the bottom a few years back. And now they're saying we're right back to that same level of jobs that we were at in 2008. Which is not so great. We're talking about 6 years where we have the same amount of jobs, and yet how many people are in the population now. Well, it turns out of those 8 million jobs we've gotten since the bottom in 2010-11, half of them have been due to the birth-death model. And by the way, 13 million people have left the labor force. And that's why we have our record low unemployment rate. So anyway, almost done here. One more piece. Just want to mention this little thing called Ukraine. I know it's, quote, de-escalating every 2 minutes, but the fact is it's not de-escalating. It's worse than ever. The sanctions are getting worse. It's turning into an East-West war of words, and hopefully it's not going to be a war of military, because that's the direction that things are moving in right now. And of course, remember, Gazprom supplies all these, a third of all natural gas of Europe, so the Europeans are reluctant to join us. Meanwhile, the Russians, the Chinese, the Indians are all joining up with Russia. So again, this is just one of the many black swans out there atop of all the other things that we own gold and silver for. Okay, well, that's enough for today. Hopefully you're starting to realize that the reality of the world is far different than what the money printing, market manipulation, and propaganda scheme is trying to tell you. And I really do believe today's ridiculous, bogus, transparent unemployment report, which, by the way, has interest rates plummeting to new multi-month, 6-month lows right now, and that tells you what the market thinks the Fed's going to be doing. That what's going on in this fake world is different than the reality. The chinks in the armor are showing everywhere, such as what's going on in the gold markets and the interest rate markets, and it's only a matter of time, like all the fiat currency Ponzi schemes before it, that this one too collapses. Which is why you need to consider protecting your net worth now while there's still a chance. And if you do, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me with any questions you might have at ahoffman@milesfranklin.com. Thank you.